Good morning, everyone. Good morning, and welcome to the trade findings and adjustments for February the 22nd, 2021. We are actually going to title this How to Survive Your Own Trading Decisions. And a link was shared to me, or PDF was shared to me by Martin Armstrong. I have that as a handout for you. If you are going to watch this as a recording and you would like the handout, all you have to do is email Hurley at hurleyinvestments.com. You'll see how to spell Hurley at the top of this page. K for Kevin, Hurley at hurleyinvestments.com. And if you're watching this as a recording later on, I will email you the PDF that we have here on this sheet today. How to survive your own trading decisions. This was forwarded to me by a friend. I'm not usually a fan of Armstrong. I think there's too much guesswork and proprietary market guessing that he uses, but that doesn't mean that he doesn't have some ideas here that are 100% spot on. And for this particular PDF that was forwarded to me, what an amazing thought process on how to survive your own trading decisions. And the keys are to understand liquidity, understand timing, and mapping resistance and support levels to help you make the best educated decision. If you're not able to do these things, you won't be a successful trader, period. The question was asked, hope you're doing well, or hi Marty, hope you're doing well. I have some questions regarding trading to you. Why is the game mentally and physically so hard to learn? Normally every trade has a 50-50 chance, but if I enter the market, everything is going different. Just trade against me and you'll become an even much richer. It's crazy. So here you have someone saying, every time I go to a trade, it goes against me, I get screwed, and if you just do the opposite of what I'm doing, you're going to make money while I lose money. His comment was, I think my biggest mistake is enter a trade too early. So very easily what this individual is trying to say is that he enters the trade early and he doesn't have the patience, the fortitude, the strength, the fundamentals, the discipline to follow through with the trade. He actually goes so far as to say, when I read the market could turn maybe in 2 weeks, my reaction was or is going short immediately. So here he is trying to go bullish. The market reverses on him and immediately he goes short. When you short a stock, when you short an option, a naked short, will someone please tell me what amount of risk is in a short position? And I should say a naked short, whether you're shorting a stock or you're shorting a call by itself without stock ownership, or a long call, a short put to offset it. If you're truly doing a straight short, a naked short, what is your risk? There you go. It's unlimited. The stock could go up to $1 million, and if you shorted it 100, you have to buy the stock at $1 million, come back, and then buy it for $1 million, and then turn around and sell it for 100. If you're buying stock at $1 million and selling it for 100, you're going to get your butt handed to you. That is just the way real life works. So here he's saying he enters these trades bullish. In 2 weeks they turn, so immediately he goes short. And what happens? It bounces back on him, right? He actually says, it's just so dumb. But what has brought me the heaviest losses this year, shorted the Dow at a resistance level at 30K, again and again and again, and it keeps going above it. So Kratz is like a market navigation. I know that. When the Navy says right, I dove left, always in fear of the market, could crash like last February. Maybe you can write, and it's funny how he spells right, W-R-T, right? Write a bit more on your blog. That were the easiest secrets to become a successful trader. Maybe a sample account. He's basically saying every time he chooses a direction, he chooses wrong. So will someone tell me, what does Hurley Investments do that is different than these short-term trades? You have to be right. And if you're using options, you actually, well, or stock, I'm actually going to tell you, it's not a 50-50 chance. It's a 33-67% chance, where you have a 33% chance to make the correct decision and a 67% chance of losing some amount of money. So please tell me, a couple of you, 1, 2, 3, 4, 5 of you are clients of mine. What do we do different at Hurley Investments? Lance, you go farther out in time. Bingo. Rule number 1. We're not a day trader. We're not a swing trader. We're not a 1 week, 4 week trader. Those sons of a bitches get their ass handed to them all the time. Oh, they brag about the big winners. They're still losing money hand over fist. That is true. We are not doing spread trades on a weekly basis, a monthly basis, a daily basis. That's stupid. Agreed. What else do we do at Hurley Investments? Mary, correct. We collar trade. And what we do by collar trading is we have 2 positions, one bearish, one bullish, where we have 2 positions that have a chance to make money. Now, our puts are going to be out a month to 6 weeks to maybe even 3 months. So we do have a time restraint on our puts, right? But we have forever for the stock to come back. So what are we doing at Hurley Investments to counteract this poor fetcher's, I think was his name, best wishes O. What are we doing that O is not doing? At Hurley Investments, we're changing the odds to have 2 positions to make money. And one of those 2 positions we can wait forever on. Another thing we don't do, we don't ever naked short. You want to blow up a portfolio, you throw a naked short on in there. You want to take unlimited risk, you sure as hell aren't going to do that in my firm. We're not going to allow that to happen at my firm. We don't take an all or nothing approach to investing. It's a methodical process where we change the odds in our favor. And the best part is our saving grace is that we have a stock position that we can wait forever, technically, for that position to come back. That is the difference on what we do at Hurley Investments. We change those odds that are not 50-50. Whatever dummy thinks you have a 50-50 chance in the market, that shows me that if I hear someone say that, you're an idiot. You haven't done the market research. You don't understand stocks move up, down, or sideways. You don't understand time decay with options. You're an idiot. And I'm proud to call you an idiot in the hopes that if you're offended enough, you'll stop being an idiot in the stock market. Understanding your abilities is huge. Guess what? I am not a really good short-term 30-day to 90-day spread trader. I am too emotional. I get pissed off. I take a loss in the stock market personally. I take it against my own. I just, man, for whatever reason, I understand I am not a spread trading guru. I'm not going to be. I do not have it in me to understand that I'm hoping for a direction, that I'm wishing things would turn around, that I understand if I adjust a position, I'm creating more risk in my portfolio. I understand those limitations, so I don't hold myself to those trading scenarios. Now, the answer for Armstrong, which again, I agree, but I disagree, they claim resistance and support. They're using a technical trend that works 50% of the time. But if you don't understand where your stock has been and how low your stock can go, you cannot make your best educated decision. He gives an interesting answer. The most common problems in trading have been overtrading and anticipation. Many think they're limiting their risk by trading too frequently. Understand, if you adjust a trade, if you are making changes to your original thought process, you are creating a new risk scenario. And more often than not, this new risk scenario is a problem. Every time you adjust a trade, every time you change your original thought process or thesis, you are taking on or creating a new risk scenario. So it's interesting. Many think they're limiting the risk by trading too frequently. They do not want to risk, say, $100, so they continually anticipate a trade and lose $20 10 times in a row. If you lose $20 10 times in a row, you actually just lost $200. The key to losing 20 times in a row, you set a stop loss. You set a stop loss that stops you out of your trade that's way too tight. In this case, it's 20% of the value of the trade. If you haven't learned anything, options lose 20% all the time. Do you know what the typical stop loss is for a stock position? The most commonly used stop is at a 4% loss on a stock position. The second is at a 10, and a third is at 5, and a fourth is at 2%. But 4%, and it's by far and away, 50% of all stop losses are 4% of the value of a stock. Do stocks move 4% in a day or two? All the damn time. You get stopped out, at the end of the day, the stock is recovered. 4% was your risk tolerance? For someone that has a 4% risk tolerance, an annuity is where their money should be. And a CD is where their money should be. It should not be in the stock market. I really love the next paragraph. The problem with systems, they require human judgment. I disagree with that. Human judgment needs to be involved in every single trading decision. When you hear people talk about taking human judgment or emotion out of the trade, that is the most comical comment that I hear all the time from educators who have never traded any real money and have no clue what the hell they're doing. In real life, if you don't use human judgment, one more time, there is no place for you in the stock market. If you truly think an algorithm, a charting program, an advisory firm, all created by humans and programmed by humans and made by humans using human judgment, is going to take your human judgment out of the stock market? One more time, you are an idiot, and get your ass the hell out of the stock market. Human judgment is what makes the difference between herd mentality and smart, educated decisions. Now, human judgment is not always right all the time. What I mean by that is there is human judgment that you're going to make mistakes. You are not going to catch tops and bottoms. In fact, we are going to be taking off some long puts we just put on 2 days ago because some things have changed. We will re-add them closer to earnings that are out in May for some of these companies. But you need to account for human judgment. And if you think taking human judgment out, taking human emotion out of the trade is a smart thing to do, from a professional that's been successful for over 2 decades in the stock market, it's time to get your ass out of the market. If you think using your brain is not helpful in your education or trading technique, I question what kind of liberal thinking you believe in, and I question if you even have a brain in the first place. All right, he had one other comment which I thought was extremely interesting. With every trade, you must define where you are right and when you are wrong. There is no depends once you put it on a trade. We only have a depend in the setup. Did it reach the time and the price? Other than that, once you're in, some people hate to look at the loss because it's acknowledging that they were wrong. If you have the setup, then you are selling against the high on the target week, or a day with a stop above the high makes sense. It's lower risk. If you think it'll crash so you can keep selling on a hunch, you will lose. I agree 100%. There's no depends in trading. The depends in your plan you do before you place the trade. I'm going to show you two things. Looking at my portfolio, I have Apple calls out to January. I'm technically profitable because I've dollar cost averaged. I have right now 8 months, 9 months basically actually, to be right or wrong in this trade. I didn't have the last 3 months where I had to be right on which way Apple was going to go. Thank God, right? If you're going to thank someone, you can't use your own judgment. I'm going to thank God. Because if you take a look at the last 3 months for Apple, it has gone from 145 down to 125. Well, it actually says 115, 116, 21. I gave myself more time than this 3 months. I gave myself a lot of time to be right in my position. I also kept cash available so that if I was wrong, I could make some changes. Boeing call. Boeing I have till January 23. I still have 19, let's see. I had 9 plus 12. I've got 21 months to be right sometime on Boeing. Baidu, 21 months to be right sometime on Baidu. And again, taking a look at a chart. If I was trying to be right on Baidu, 350 all the way down to below 200. If I gave myself 3, 4, 5, 6 months, a month, I just got screwed and trading Baidu bullishly. If I was trading it bearishly from the highs in February, right? This direction, and I was shorting Baidu because I didn't understand what dual registration means. Because I got caught up in the, oh, China's going into the tank, and I was shorting it. Boy, to short it for 3 months at 150, you have to buy it at 350 and come back down here to sell it at 150. I just lost $200 a share. Use time as your friend when you're making trades. Costco call January 23. Disney call January 23. GE Vertical January 22, 9 months out in time. General Motors January 22, 9 months in time. Protective puts on Under Armour. Protective puts at between 10:30 and 11 o'clock. We are going to take off on Under Armour because it has changed. The narrative has changed. Meaning, for both Disney and Under Armour that we added puts on, we're getting a bounce a different direction. We're getting back above the 50-day. At the end of today, we are going to take off long puts and put them back on a couple weeks ago because Under Armour is breaking the narrative. They're bouncing above a 50-day simple moving average, which usually triggers more buying. Kevin, what if you're wrong? Well, we might take it off today and add it back on tomorrow and just leave it. But technically speaking, we're getting our crossover on the RSI. A 5 and a 20-day is definitely crossing over. We're almost crossed over on the MACD. We're going to use our best educated decision and take some things off for a pre-earnings run on Under Armour that reports the middle of May. Same thing with Disney. Disney looks like it has that bounce. It looks like it's trying to get back above a support level. We might wait on Disney a couple more days to see if it can get above the 50. But if it does, we're going to take the protection off of Disney. We're going to say, hey, bad timing. We're gonna move it and adjust it for an earnings event which has the most probable big movement. Ford. We did not add protection on Ford. We suffered through the down to $11.18. We're bouncing higher, looking like a doji, so we might put some Ford protection on today. Thank goodness we're doing it at $12, not at $11. What's the difference there? Well, if you take 1 and divide it by 12, we're adding it 8.33% higher than we could have added that protection starting yesterday or Tuesday. Kevin, how did you miss the break on the 50-day? Well, it fought the 50-day for 4 days. When it broke it one day, we decided to let it go one more day to see what happens. Well, what happened the next day? Big drop down. We missed it. You know what we don't do? We don't beat ourselves up for an 8.33% drop in a stock. We missed it. Have we made 30, 40, 50% drops on the stock? Of course we have. Are we going to cry and piss and moan about an 8.3% drop on one position in a portfolio? We could. We could really be dumb and just beat ourselves up. We suck. I got to quit. Turn everything into cash. Once again, if you act that way, you're an idiot. There is no place for you in the stock market. Get yourself out now. One of the most interesting questions I always receive. Kevin, what do I do if I fall into, and it's mine, I'm too stupid to be in the stock market category? And again, I kind of giggle, right? Because it's not hard. It's not hard at all. What do you do if you fall in that for me? Simple. Get the hell out. Or stop watching your portfolio on a daily basis and try looking at it on a quarterly basis. Oh my God, Kevin, I did that in 2008. I got my butt handed to me. Oh my God, Kevin, I did that. And in last year, I got my butt handed to me. I lost 28% and it took a 43% return just to get back up to break even. Well, if you can't do the or, which is step 2, go back to step 1. And it's really simple because it's there. It's in all caps. It's now highlighted for you. Get out of the stock market. I love what I do in the stock market. I love the protection I get to add to people. You know what I hate? I hate hearing some dumbass talk about average returns. I hate some dumbass looking at periods of time and not looking at the whole picture. I hate people that are dumbasses that can't calculate a return on their portfolio. I don't have the time for those individuals. I hate people that beat themselves up. I hate people that think the stock market's easy. I hate losing in the stock market. It really chaps my hide. I hate how I act towards other people, mainly my family, when I lose in a trade. That's why I don't do a lot of spread trades. I don't like the person that I hate the person that I am when I'm frustrated about my money in the stock market when I'm in a losing trade. So guess what I do? I get the hell out. I don't place those trades. I place the trades that I have a high probability, long years of time to be correct. And for some of you, you guys have had the benefit of seeing what that does. And what does it do? Instead of waiting 20 years from 2000 to 2020 for the S&P to finally double, we are doubling portfolios every 4.5 to 5.5 years. That is what we're doing at Hurley Investments. We're giving ourselves the ability to sleep at night by adding the long put as protection during the most volatile times that stocks move, which is their earnings. We are converting the profits from long puts into more shares to give you an exponential return when things bounce back. We take profits from stock positions and convert it to leap long calls years out there in time to leverage your profits for even a more leveraged return down the road with a lot less risk. We are using profits to make profits instead of initial investments. I love what I get to do at Hurley Investments. I love how it's benefited me. I love the challenge of being in the stock market. I love being right. I get frustrated when I'm wrong, but it's not the end of the world. Guys, what questions do you have for me that I can answer in regards to investing or trading? And Abraham, I know you do some trading. Ida, I know you do. Dave, David, Lance, Mary, I'm pretty sure you guys do. Jim, I don't know about you. Lee, I don't know about you. In fact, Jim, I know you're still trying to get through the education, so that's where your focus should be. I hope you're not doing some spread trading on your own. Great question. So, Kevin, what advice would you give someone that is new to trading? The short answer is, if you're new to trading, you should be paper trading your guts out. You should be placing every single strategy that you're learning. You should place it a couple times on how you think it's going to work properly. You should place it a couple times on doing it wrong. You should place it times with bad setups, good technicals, bad technicals, during earnings, now during earnings. You should trade that strategy 10 to 15 to 20 times to see and map. And if you need to, if you can't keep it in your head or understand it, create a trading journal to show you the opportunities and losses available to trading a spread trade. You should calculate on paper your initial trade, what you're going to do if it goes up, down, or sideways. One of those ways should be your maximum profit. You should see and calculate the new risk when you adjust a trade. You should see and understand and learn the benefits of letting positions run when they're technically going the direction of your trade. You should see and understand what it means to take 90, 80, 75, 95% of your potential profit, and if it's worth getting out early. If you have a 75% maximum profit of your trade, why would you risk 75% of your profits to try to gain another 25? If you have 90% of the profit in your trade, why would you risk that to gain another 10%? The risk to reward ratio is out of whack, or your brain is out of whack. And once again, you shouldn't be in the market. If you think it's okay to risk 90% of your profits in a trade to gain the last 10%, you're an idiot. You don't understand the money. You shouldn't be trading in the market. What is the key? A profit. A profit's a profit's a profit. And as long as you're booking profits over and over and over again, you're going to be more profitable than your losses, and you're going to make money in the stock market. Notice there's no percentage on the amount of money you should be making in the stock market. It doesn't matter if you make 5% or 50%. The key is to make money in the stock market. Guys, I see no other questions coming in. I appreciate your time today. I hope this was helpful. I will post this quickly on how to survive your own trading decisions. If you guys go to your handout section, I've got a PDF of this Armstrong article that was emailed to me. Please take it. You got to give credit where credit's due. I am not a fan of Armstrong. I do not agree with most of what he puts out, but this was a really good article that I think helps individuals in general understand your emotions and understand what you're doing in your trading when it comes to investing in the stock market. Again, I corrected some things in here. You see, I don't agree with everything. You can agree with everything. In fact, you know what the neat part is? You can disagree with me. I am 100% okay with you guys disagreeing with me. But if you are disagreeing with me, you know what? It's probably time for me to turn your money into cash it's probably time for me to say it was real, it was fun, it wasn't real fun, and it's time for you to go somewhere else. Go somewhere else and see what you think, see what the results are after a couple of years, and make a decision if that was one of your best things to do. Guys, I appreciate you being here. As you can tell, hopefully you can tell I'm back on board. I'm back getting better, feeling energized. I'm off to my cocky, arrogant ways again. I so appreciate all of you being here today. Thank you very much. I look forward to seeing you next Monday, and I'll work on having this posted sometime this afternoon or this evening. Thanks again. Talk to you guys later. Have a great one. Bye-bye.